Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Velasquez. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to Pique Your Interest podcast. I am Tanner Greenwald.
And I'm Tim Velasquez.
And we're kind of re-going over our last episode. Our last episode was based around debt. We briefly touched about student loan debt, and we wanted to do a video that breaks down student loan debt, how we calculate it, what we're looking out for, all the good stuff, all the fun things with student loans. Everybody, well, I shouldn't say everybody has them. Most people have student loan debt, and they, as the world kind of keeps going on, those balances tend to increase.
Oh, yeah.
So we're just going to kind of break down student loan debt, like I said, what we're looking for when we pull your credit report and we see student loan debt, how we calculate them, all of those good things. So we are going to start off by explaining why it matters. Why do we have to count it, all that good stuff. So, Tim?
Yeah, so, it's important to know that, as part of our job is helping people qualify to buy houses. And part of that is, we pull a credit report, look at the debts that appear in your credit report. And I don't know about you, but now more than any time in my career, student loans are impacting, a client's ability to, whether or not they can buy, and then if they can, it severely limits in a lot of cases what they can qualify for.
Yeah.
Why are we doing this is important, and I've got some stats. I did some research, and found that over 42.5 million Americans have student loan debt, and the total amount that they owe is 1.81 trillion with a T, which makes the average debt, the average student loan debt's over $42,000 per person. That's an awful lot of money to owe in anything, but particularly student loans, and it takes forever to pay them back. In most cases, this debt has to be counted against people, and so us having an understanding of how to calculate student loans is imperative to us doing our job, but also kind of communicating that to clients and saying, hey, you have, student loan debt, this is how it impacts, if you didn't have the student loan debt, maybe this is what you could qualify for, kind of thing. In the previous episode, we talked about debt to income ratio, how much money you're spending versus how much money you're bringing in. And student loans have increasingly become a big part of that DTI. Yeah. And then something that probably shocks people is, even if loans are deferred or in forbearance, we almost always have to count some kind of debt against you because you have these student loans. Even if you're not actually making payments, even if they're deferred or you're in forbearance, you still need to be making these payments, we still have to count these against you, even if you're not really making the payments. And there are various ways that we do that. Mm-hmm. And Tanner's going to tell you a little bit more about how we calculate repayment.
Yeah, so, typically the first thing we do when we pre-qualify somebody is we have to pull a credit report. That's us knowing your score, your debts, and on the credit report, it usually breaks down any type of student loan debt that a client has. Sometimes and I guess it also depends on who your carrier is with student loans, because they break it down differently, meaning they might show it on the credit report as one lump sum. They might break it down into different balances based on the different loans you've taken out, whatever the case is. But when we're looking at the credit report, we're looking at, do you have a balance on the student loan debt? Is there a monthly payment reporting on the student loan that is on the credit report? What is the monthly payment? If there's not a monthly payment, what do we do? So we start with the credit report, and that usually is kind of how we know how to go to the next steps. What do we need to do next? Typically, when I see that there's student loans on anyone's credit report, I automatically ask them for a copy of their student loan payment plan.
Right.
Sometimes people are in income-driven repayment plans. Sometimes people, I don't know exactly what the plans are called, but I know income-driven repayment plan is a very popular one. Sometimes they will amortize your loans out. If you've got a big balance, let's say you have $50,000 worth of student loan debt, and they amortize your loan with them out 15 years, then they'll give you a monthly payment, things like that. So, I'll always ask for an income-driven repayment plan. And then sometimes, like I said, there is an account, a statement, maybe you're paying already into them. So we just get a copy of that, and we prove that this is, exactly your payment that's reporting on the credit report, all of that good stuff. If there's nothing reporting on your credit report, let's say there's a $0 payment, that's when we kind of want to say that the lights go off in our head where we're like, okay, well, we need to have some sort of monthly payment for this debt.
Yeah.
So that's when we have percentage calculations on the back end that we kind of go into our guidelines. We look at what percentage we need to calculate, and we put it towards each loan type, which we're going to break down a little bit in this episode as we go on. And then sometimes, in very super rare occasions, the monthly payment is like $0, and I think that's with VA loans. And Tim's going to touch on that in a little bit. But these are the different ways we kind of look into figuring out what your monthly payment is for these student loan debts and how we are going to calculate it. So let's break it down for each loan type: FHA, USDA, VA, conventional, all the fun things.
All the fun. I think what we find is that a lot of these calculations are very similar to each other, and so it's not rocket science trying to figure this out, but keeping up with the rules, any kind of guideline changes, just knowing what it is that we're doing and how to calculate it is, part of what we have to do. So if you're going to be doing a conventional loan, under conventional loans, there's Fannie Mae and Freddie Mac, and a lot of times their guidelines run, linearly to each other. They're all the same, and then sometimes they kind of like divide. And this is one of those things where they divide. So the way that we calculate student loan payments on conventional loans is, with both Fannie and Freddie, we look at, what does the credit report say? Because if the credit report reports a balance, you could use that. Now, you also could actually get the loan documentation from the student loan servicer, and if that payment is less, we can have the credit report updated for that. So, but the first thing we do, like Tanner mentioned, is we look at the credit report, look for a balance there, look for a payment there. If it's not there, you can request, this income-driven repayment plan information, or you can get whatever the documentation is, like the student loan statements that show what the payment would be. Yeah. If you can't get that for some reason, and it's not all that uncommon that people can't track down this information, or just don't know how to go about getting it, and that's okay. Then we have to use a percentage of your outstanding balance, and so with Fannie Mae, we use 1% of your outstanding balance as a monthly payment against you, and with Freddie Mac, you only use 0.5%. So it works in our benefit and to the client's benefit if we can use Freddie Mac, because you literally count half of the student loan payment, and that may or may not sound like a whole lot, but it makes a huge difference. It does. We've got some math for you later on in the episode to sort of illustrate how much of a difference that makes. Maybe that makes it a little more tangible for you, but with conventional, try to use the credit report. Can't use the credit report, get a statement. Can't use the statement, calculate based on a percentage. Actually, it becomes almost like second nature for us to kind of calculate it like this. That's just how we do it. And so that's conventional loans. FHA loans, same thing. Use the credit report. If the credit report doesn't show anything, try to get the income driven payment plan, or get the actual statement from the student loan company. If that doesn't work, FHA falls in line with Freddie Mac. You use 0.5%.
Which that just recently changed, didn't it?
That did recently change. That was like the last year or two.
For people.
No, it was great because it used to be 1%. So now we're literally counting half of what we used to count for FHA, which is awesome. Yeah. Awesome. Because, people that are getting FHA loans are lower credit score, need a little bit more help in qualifying. You can't go as far on debt to income ratio when you have a lower credit score. So when you get a relief like this where you only have to count half versus a whole, it, again, doesn't sound like a big difference, makes a huge difference in, being able to qualify. So it's, thanks FHA.
Yeah, it was a relief to us too. Thanks, FHA.
Yeah. And then VA loans, like Tanner had mentioned, we do the same thing. You look at the credit report. If it has a balance, great. If it doesn't, you get the paperwork. If it doesn't, if you get the paperwork and it shows there's actually a zero balance or a zero payment due, or you can show that these loans are in forbearance or deferment for at least 12 months after your settlement date, we don't have to count a payment against you at all. And this is the only time you can use zero, absolute zero, which is really nice. It works out awesome if you can get that. There aren't a ton of VA people that have student loans, but every once in a while it works out and it's like a nice sweet spot. Yeah. If you're not one of those people that's lucky enough to have zero, and you do have, you have a balance on your student loans, and we've got to calculate a payment, VA is like the quirkiest, like funkiest way to calculate. So they actually will take 5% of your outstanding balance and divide that by 12, because there's 12 months in a year. That is your monthly payment that we have to count against you, and that comes out to be it comes out to be a lot less than calculating most other ways. So either way you slice it with a VA, it's very favorable for for buyers. USDA loans, same thing. Credit report, income based, all the paperwork. If that doesn't work, they fall in line with Freddie Mac and with FHA, and you use 0.5% of the outstanding balance to calculate what we have to use for your debt to income ratio. We have a couple of examples for you. I think this makes it a little bit more tangible. Tanner's going to start off with conventional and FHA.
Yeah, so we have an example. So let's say that there's a student loan balance of $40,000 and it's reporting on the credit report, but like I mentioned before, sometimes there is no monthly payment. The monthly payment shows as $0. They don't have any type of repayment plan established. So we're going to go over how each loan type would basically calculate that. So again, $40,000 worth of student loan debt. Yeah. Conventional, so if we're going Fannie, like Tim had mentioned, we would use 1% of $40,000. So we would literally take $40,000 times 1% and we would get $400. Yep. So $400 is what we would have to count monthly payment-wise as a debt against you for that $40,000 student loan that you carry. If you were to go Freddie, so we just talked about Fannie, if you were to go Freddie, it's a 0.5 percentage point. So a 0.5 percentage point of $40,000 is $200. So $200 would be the monthly payment in that case scenario. And that would be if you were going conventional. FHA, like Tim had mentioned, it's a 0.5 percentage point. So we would take $40,000, take a 0.5 percentage point of that, and it's $200 a month. And that would be what we would count as a debt against you for that, for FHA.
Yeah. And we would do the same thing for USDA. So, you have a $0 payment on the credit report, can't get any documentation for what the real payment might be. We just use 0.5%, which would come out to be $200. So USDA, FHA, Freddie Mac, all calculate the same way. So that works out pretty easily. VA, here's where it gets a little bit different. So remember, you use 5% of the outstanding balance and you divide by 12. So 40,000 times 5% divided by 12 is $166.67 a month. Doesn't sound like a huge difference, but sometimes that $34 or $35 makes a huge difference in a loan getting approved or a loan getting denied. So any little advantage that you can get makes things a little bit better, a little bit easier, easier to qualify, and we'll take that all day long. That's a win.
Yeah.
Now, there is a really cool program that's out there that has everything to do with student loans. It's specifically geared towards student loans, and we're actually lucky enough to have a resident expert to talk about it today.
I wouldn't say expert. I just recently had a loan close that utilized this program. So the Maryland Mortgage Program, which is a big state program in Maryland, they have a student loan program called the Smart Buy product. Yep. So essentially the way that the program works is they will be giving you $20,000 to pay off any student loan debt that you have. It's a conventional loan only, so we can't do FHA, can't do VA, can't do USDA. It's just conventional. The caveat to this program, because sometimes programs have caveats. So let's say, back to our example of $40,000. Let's say you have $40,000 worth of student loan debt, but this program's only willing to pay off $20,000. The rule set by the program is at the settlement table, they're willing to pay off $20,000. You have to come up with the rest of that extra $20,000, and it all has to be paid off at the student loan table. Or at the student loan table, at the settlement table. Good Lord. With that being said, it's minimum, if you're a first-time home buyer, which I'm pretty sure you have to be in order to use this program anyway, it's 3% down. It's a great program to utilize. I just had somebody go through it. So she had her student loan debt paid off. She did have to pay off a little bit of balance remaining. She had no problem doing that. It's just a great product to use. They do allow you to pair it with another program to get assistance on the back end that the Maryland Mortgage Program has as well, which is client utilized as well. So she got some of her student loan debt paid off. She was able to utilize, I think she got $6,000 as background assistance. And the good news is, after you living in the property for 5 years, that $20,000, it's almost like bits and pieces that are taken away after 1 year, 2 year, 3 year, 4 year, and at 5 years it becomes completely forgiven, and you never have to see the $20,000 again. It's gone. Yeah, which is great. Awesome. Yeah, it's awesome.
Yeah, I mean, I think the biggest challenge is there are a lot of people out there that have more than $20,000 in student loan debt, right? Because the national average is 42.6, I think is what we said. So it's really hard for some people to get all of their student loans paid off with this program. But if you're one of those people that has $20,000 or less, or just around $20,000, and you're willing to pay a little bit of it off, this is a fantastic program.
Yeah, I would agree. I would totally agree. So I feel like that's what we have on student loan debt.
I think more than any other debt, this is the one that sort of like boggles people's minds, and honestly, I think it impacts their ability to buy a house more than anything else out there. People have always had car loans. People have always had, some kind of level of credit card debt. But the student loan debt has increased so much over the course of our careers that I think it impacts more people. So I think it becomes more important now than any other time to make sure that you're working with somebody like Tanner or me that knows how to calculate this, that knows how to sort of walk you through, and who also knows about programs like the Smart Buy. Like there aren't, not every lender is allowed to work with the MMP.
That's a good point. Yeah.
Right? Like not everyone has this loan to offer. It's something that we do. It's pretty cool. So we tell you all the time, it's really important. Who you work with really matters, but it really truly does, because in a situation like this, if you're working with, some internet lender that you found, they're probably not MMP approved. They're probably not offering the Smart Buy. They're probably not even talking to you about, hey, here's how we can structure your loan. Here's why it would be better to go FHA versus Fannie Mae, or, whatever the case is. So, who you work with matters. We'll keep beating that drum until the day that we die, but it really does make a difference. And so, we're here to educate you. We're here to help you. So if you have any questions, reach out to us. That's what we're here to do. Okay?
Absolutely.
All right.
All right.
Well, thanks, Tanner.
Yeah, thanks,
All right,
Tim.
we'll talk to you guys soon.
Have a good day.
Bye.
Bye.